Joined by St. Louis Fed President James Bullard. So, Jim, it isn't every day that we have a vice president on talking about the Fed and Fed policy, and I get to throw it at a president, a voting member of the FOMC, who says you ought to be lowering rates and maybe not considering the employment mandate, just have an inflation mandate. Take it away.
I actually have supported a single mandate for the Fed in the past. I've said that it would clarify what the Fed can actually do over the medium term. I don't think actual policy would change very much. We would still react to the economy and everything, but it would clarify in people's minds that the only thing the Fed can do over the medium term is try to control the inflation rate.
Do the president and the vice president have a point that growth is strong, inflation is low, and the Fed ought to be cutting rates, and if it did cut rates, the economy would soar?
I think the way you have to think about the current situation, you have to step back a little bit. There's been a sea change in U.S. monetary policies since January 4th when the chair was at in Atlanta at the AEA meetings. That sea change has altered the structure of interest rates, and you can really see it in the 10-year. The 10-year was trading at 3.25 last fall. Now it's trading low 250s.
It was 350 at a point.
You're talking 75 basis points on the 10-year. I would attribute the lion's share of that to changed Fed policy. We know there are long and variable lags. You got to wait and see how big an impact this has on the economy. So I think we're in great shape today. We've got a great jobs report. Inflation's a little bit low. We can talk about that, but we've already made a gigantic change in policy, which I welcomed and supported. Most of the committee came to my view about the flat rate outlook, and this has had a big impact.
So you're saying that you've already eased through what is sort of derisively called open mouth operations by changing your stance on the forward outlook.
Policy isn't just the rate; it's the expected path of the rate over the next 2 years.
Right.
And we used to be saying, 50, 100 basis points on that path. Now we're saying zero or very close to zero on that path.
Down and real rates in the economy down.
Absolutely.
Let's talk about this jobs number. I mean, did your eyebrows go up sort of towards the top of your forehead when you saw
it's
260
It's
plus?
a good number. It sounds like since the first of the year, we're about a 205 or something on average. A little bit lower than last year. So this is consistent with the idea that 2018 was going to be a little bit faster growth than 2019. I think the news in the last month, the news is that we're not going to get this slowdown to below 2% GDP growth. Instead, we're going to slow down to 2.5%, which is, more moderate type of slowdown in 2019 compared to what people were expecting.
I mean, I get that, but it looks more like we're closer to 3. I mean, we did 3 in the first quarter.
And there's upside. There's upside potential that you could just stay at 3. You got this good productivity number, which I love. Looks like productivity is picking up. There could be supply side effects here that are kicking in, possibly because of the Tax Act. So I think some good things are happening, and it could be that you get even higher growth in 2019 than the numbers I just said.
Okay, so I'm going to get to Sarah in just a second. Sarah, if you would just with me, if you have a 2.5 forecast with a 3 upside, is 2.4 the current funds rate the right rate for that environment and that potential?
Well, I think we're a little tight on the funds rate, not too much, but a little bit tight. I think the global safe real interest rate, short term, is about 0. And if
real rate.
Real rate.
So let's explain that to people.
The real rate is 0. If you add the 2% inflation target to that, you get to 2%. We're at 2.40. Sounds a little bit tight to me. I don't think it's something to really worry about, but it sounds a little bit tight. And you've got core PCE inflation running at only 1.6. It's making me a little bit nervous. I think inflation expectations are a little on the low side.
So do you agree with Powell that it's transient?
I would like to recenter inflation, take this opportunity to recenter inflation expectations at 2%. I think that would pay handsome dividends for the Fed going forward.
We'll come back to transient. Let's get Sarah's question. And sorry about that, Sarah.
Well, my question's on transient, Professor Bullard. I was wondering what you made of the market reaction to the Fed meeting. I mean, it seemed like there was some real disappointment in market positioning around the fact that Chairman Powell describes inflation as transient or transitory, and therefore suggested it's not persistent enough to make a rate cut.
Yeah, I think, again, we've made a big move in monetary policy over the last 3 or 4 months, and I think it's time to wait and see how that's going to impact the economy going forward. It's true that the core PCE numbers have come in a little bit light, but of course there is noise in the data, as the chair noted, and you could look at the Dallas Fed trim mean, which is a measure that I have liked in the past. That is at 2%. So I think this is a point where we probably want to be assessing the data. So,
Jim, if indeed we're going to be running 1.5 core PCE, which is the better measure you guys think of inflation, how tight is the Fed here? Do you think it ought to be cutting rates?
Well, like I say, I'm not averse to the idea that we should try to recenter inflation expectations while the economy is good and make sure that we're centered at 2%. They look a little light to me. It looks like markets expect, something below 2% inflation over the next 5 years. And I don't think that's a good place for us to be. There will be days in the future where the economy is not performing so well, and those expectations will go down even further. So I think it's a reasonable option is to try to recenter inflation expectations on 2%.
Tell us how, as a policymaker, you react when you hear the president talk about what the Federal Reserve should be doing with interest rates.
Well, as you know, all these discussions are get very technical very quickly, and so I think we have our mandate. We're supposed to get full employment. We're supposed to hit our inflation target and keep inflation low and stable. Many factors come into that. We get advice from all kinds of people, including you, and and including other politicians. You know, the chair goes before the Senate Banking Committee, House Financial Services Committee. They all comment on monetary policy. So we get a lot of input from a lot of different angles. We're used to that. And we try to make the best decisions we can. But we do have this mandate we have to come back to. That's in law.
All right, Jim, I want to see where your forecasts are here. We're at 3.6 now on the unemployment rate.
Yeah.
How low does it go, and at what level does it make you more nervous about the potential for inflation?
You know, I think we've talked about this before, but the empirical Phillips curve is very, very weak in this environment. You might be talking about a ratio of 10 to 1, so you'd need 100 basis points of gap to get 10 basis points on inflation. And, you know, what do you think? 3.6, is that 100 basis points below the natural rate? I don't know. So a lot of people think not. So how much inflation do you really think you're going to get out of this low unemployment rate in this environment?
And then before we go, real quick, your GDP number for this year?
I'd be at 2.5 sitting here today.
Great. Jim Bullard, thanks very much for joining us.
All right. Thanks
a lot.
And
we'll check back with you at the end of the year. Okay.